Good evening. Dodge & Cox is proud to be a sponsor of SIEPR Economic Summit. It's been an incredibly stimulating day, and we're very proud to be part of it. It's a true privilege to have the opportunity as well to introduce our distinguished and accomplished moderator and keynote speaker for the evening. First, we're fortunate to have our very own John Taylor, the beloved professor of economics at Stanford, senior fellow at SIEPR and Hoover Institute, and perhaps most importantly to my Dodge & Cox colleagues, the lead independent trustee of the Dodge & Cox funds. We're also very fortunate to have our keynote speaker, Jean-Claude Trichet, who's been a leader on the world stage and on the forefront of economic thinking throughout his distinguished career. I'm personally looking forward to hearing his views on the global economy in light of all the changes in China and other areas around the world. And the timing couldn't be more perfect in terms of the changes in the increasingly extraordinary monetary policy that we're seeing deployed by central banks worldwide in terms of quantitative easing and negative rates. In addition, I look forward to hearing his views on the current state and future of the Eurozone, given rising political tensions, migrant issues, elections, and disparate economic performance among its member countries. Among Mr. Trichet's many positions of influence and innumerable awards, I'll highlight just a few. There's many more in your program. Mr. Trichet has held leadership positions throughout his career through the private sector as well as in the French Ministry of Treasury and Finance. Interesting to me as a debt investor, he serves as the chairman of the Paris Club from 1985 to 1993, dealing with a massive sovereign debt restructuring, and he did that masterfully. In addition, he led the European Central Bank as president for 8 years in the lead up to and in the midst of the financial crisis. And during the crisis, he relentlessly pushed the group to focus on unity and strong governance and advocated for open trade and competitiveness. And he used his strong leadership and diplomatic skills to unify across culture and language and improve communication regarding their new monetary tools that they were using to both their citizens as well as to the financial community, which is no easy task. And for this work, he was awarded many, many awards and accolades. I'll just name two. One was the International Charlemagne Prize for his work on the European unity. And he also was named the 2011 Global Prize from the Kiel Institute for the World Economy. Mr. Trichet has always been a friend and ally of the United States. He currently serves and continues to push our thought forward in economic thinking as chairman of the Group of 30 in Washington, and also chairs the Trilateral Commission for Europe, among many other think tank posts. So please join me in welcoming Jean-Claude Trichet.
Thank you very much, Dana, indeed. Thank you very much, Dana. Indeed, it was a much too flattering presentation. Let me only say that it's a great pleasure to be here. It's not the first time. I've been invited 6 years ago, and I have always appreciated enormously the atmosphere of Stanford, the oxygen that you are breathing in the bay and in the valley, and the extraordinary entrepreneurial spirit that is there. You were, I said, much too flattering, Dana, with me. It reminds me the story of such a very flattering introduction, which was concluded by, and it is a pleasure to introduce the man who made billions of dollars in discovering oil in California. And the speaker came and he said, that was very flattering, but I have to correct a little bit what you said. First, it was not oil in California, it was coal in Oklahoma. Second, it was not billions of dollars, it was millions of dollars. Then I have to confess, it was not a profit, it was a loss. And he concluded, but highly fortunately, it was not me, it was my brother. So, again, great pleasure to be here. So, let me only say a few words, if you permit, Jean. And again, it's an immense pleasure to be with you again after a very long companionship at the time where you were Undersecretary of the Treasury and I was myself the equivalent in France. I would like to share with you some observation on the global economy, as has been announced, and also perhaps share with you some observation on the monetary policy of the central banks in the advanced economies, where I see a number of very interesting convergence, what I would call conceptual convergence. First, on the global economy. We are experiencing clearly a period of disappointing growth. When I look at the analysis which are made by many economists, by the international institutions, I think the summing up can be the last IMF report updated, subdued demand, diminished prospects. And as a matter of fact, a lot of projections are reviewed down regularly. And I expect that at the level of the global economy, the IMF will review down the last projections, which were 3.4%. The OECD is already at 3%. And when you look at the various economies, advanced economies, the US, Europe, and the emerging economies, you see the very same successive disappointment, if I may, or reviewing down, which doesn't mean at all that we are about to observe a recession, but it means that we are now many years after the start of the crisis, 8 years after the start of the crisis, approximately, we are in an episode of the global economy and of the economies of the various major components of the global economy, which is disappointing. And we had some kind of echo of this situation this afternoon, for instance, all the day long, with some malaise which exists obviously in the advanced economy. We have, as I said, rather disappointing real growth. Many years after the start of the crisis, we have still a difficulty in many countries, many advanced economies countries, to catch up with the level of output that we had before the crisis. The US now is significantly over and above, but it was a long period of time to catch up. And in Europe, we have a number of countries that have not caught up yet. We have disappointing productivity growth, and therefore disappointing, in the eyes of many economists, growth potential. We have the threat of deflation, which is something very, very serious, and of course has a bearing on the monetary policy of the central banks. And to sum up the situation as one might see it, if you take the advanced economy and you make the thought experiment, what would happen exactly in the advanced economy if the central banks were not still delivering extraordinarily accommodating policies? You might perceive that we would have an immense difficulty with the spontaneous functioning of our advanced economy, so that it is a measure, if I may, of the real difficulty which we have today in the advanced economy in general. And as a last remark, I would say, in this environment, not surprisingly, we see the emergence or the re-emergence of the secular stagnation, which you remember was a concept which was floated at the time of the 2930s crisis. Now, let me say that in my vision, all this has to be nuanced, fortunately, and I see 5 reasons to nuance this pessimistic vision of growth in the advanced economy as well as in the emerging economy, say growth at a global level. First, I think that we have to fully realize that we had a very abnormal financial cycle of over-indebtedness, public and private, before the crisis exploded, and that we are probably still in the shadow of this dramatic over-indebtedness, namely that in most economies we still have a level of deleveraging which is still insufficient. And it has a bearing, of course, on the real growth and on the performance that we would hope. Second remark is that structural reforms, we know that, are badly in need in a lot of economies, not only in Europe, where it is absolutely overdue, but also in other advanced economies. And I could see this morning, for instance, that if the US itself has a growth potential which looks unsatisfactory, perhaps education is part of the problem, and this is clearly one of the structural impediments that one has to cope with. Not to speak, of course, of, as I said already, the European economies and Japan, where the third row is still to be launched and not yet launched. So this element is, of course, negative in terms of immediate reading of what we are seeing, but it means that if we embark resolutely on the structural reforms that are overdue, we should normally, of course, benefit from the growth which goes with a better functioning of the advanced economy in particular. But as I said, it's not only the advanced economy which are at stake. A third remark which would nuance the pessimistic view is, and I draw from the session on productivity this afternoon with Nick and Hal, that we probably are under-assessing real growth and real productivity progress because of the digitalization, which makes a lot of consumer surplus that are for free and are not contributing to growth. And I think we had a number of examples. The best example I have is music. I'm told by economists that if you take music consumption over the last, say, to oversimplify 10 or 15 years, the consumption has considerably augmented. Namely, all our youngsters and ourselves are listening to music in a way which is digitalized now, but very, very impressively superior to the volume of consumption of music that we had before. Still, to the extent that the atoms have been replaced by bits, the contribution to the GDP in all our economies has shrinked. And I'm told that probably by a factor 2 or even more in some economies. So you have a volume of production, the output, that has augmented considerably, but the contribution to growth has diminished considerably only by the virtue of digitalization. And this is only one example, but again, when we are listening to Hal and Nick, it seems to me that they had other examples. So I draw your attention to that, and after all, we are in SIEPR, and it seems to me that it is an area which is extremely important in terms of economic research, to understand better exactly what's happening and what are the totally unintended consequences of digitalization if it is for real that we will, in the years to come and the decades to come, under-assess output, and only because of digitalization, and therefore under-assess the productivity progress, which in my own intuition are gigantic when I see what I can do with my Apple iPhone. I know that my productivity has fantastically augmented, and I don't see that too much in the figures. It's a new solo paradox, if I may. Now, there is a point which I hesitated to make, but after having listened to what was said also today, I have to mention it. part of our pessimism comes out of this permanent threat of deflation that we see with a very low level of inflation, which is, of course, partially due to the very low price of oil and commodities, but is also, in my own reading, perhaps due to the fact that the bargaining power of organized labor in the advanced economy has considerably diminished. So that the unit labor costs, whatever level of productivity progress you have, are very flat. And if you have unit labor costs in Japan, in Europe, in the US that are not dynamic at all, then of course you should not be surprised to have a national inflation which is very low also. So to the extent that we were told that there might be a problem of frustration of the unskilled workers in our own economies, I see something there, a connection perhaps with one of the major problems we have, and certainly that we have in the central bank constituency, namely this persistent low level of inflation. This was, I have to say, my, I would say, bold remark. Now, a last remark, which is a pure arithmetic, but I utilize precisely my iPhone computing capacity to recheck what this disappointing growth of 3% real growth per year, which is probably what the IMF will produce in the update that they will do now for the next meeting in Washington. If it is confirmed that we are at the level of 3%, I am not sure that you should be, and we should all be desperate in terms of medium-term real growth, because if you continue to have only a 3% meager growth at the global level during 35 years, say the equivalent perhaps of a large generation, you multiply the output by approximately 3, exactly 2.81, which after all, if really for a baby being born today, in 35 years, it sees that the output of the planet has been multiplied by 3, it is not totally negligible. And if it would be pursued for 100 years, and what is 100 years in the, I would say, comparison with the human civilization, then the multiplication is by 20. So output multiplied by 20. There we are back to the digitalization, because we know for sure that the atoms that are produced will not be multiplied by 20. That is absolutely certain. And we also know that the bits will be multiplied by much more than by 20, because we see the multiplication of the bits, of the bit production year after year. So I draw your attention to that. I mean, what we consider very disappointing might only be a short-term consideration. If we could sustain the level of disappointing growth, real growth, that we observe presently, maybe it is not that dramatic. Now, a last remark on the risks for the global economy at the present moment, and then I would only list a number of risks and perhaps stress a little bit more those which are particularly important for Europe for a reason which I will explain. Then we have the Chinese question mark, which is certainly a very important one. I remain highly optimistic in the long term on China. I have no doubt that they have a potential which is still absolutely gigantic, but it's true that the transition is certainly a difficult one, and we have to take that into account. We have the risks associated with oil and commodity, and the possibility that we would have a very persistent low price that would, after a certain time, create enormous problem for oil producers and for also, by the way, for the central bank's monetary policy. If, again, this very low level of oil and commodity is so persistent that it would unincur inflation expectations. But I would also say, of course, that this very low level of oil, if persistent, will create big problems for the producers. I already said that. If I take the BRICS, the 5 countries, all have potential problems which might materialize at the level of I would say, global risks. If you have big problems in the various BRICS, apart from India. India is the only of the BRICS that looks reasonably solid and resilient in the present period. We have, of course, the risk associated with the financial markets themselves. And there I would only mention the fact that what I see myself all along my career was the emergence of new properties of the highly interconnected financial world and real economy world in which we are, thanks to technology, thanks to globalization, thanks to, I would say, conceptual innovation. And we could, of course, experience one of these emerging property when we could see after Lehman Brothers collapse that the contagion at a global level could take place as a matter of half days, when in the 2930s, it would have taken perhaps a quarter to come from one possible bankruptcy to the second possible bankruptcy. But the level of interconnected finance and world in which we are is such, as I said, that had the central banks not reacted as a matter of 2 days and a half, we, in my opinion, would have experienced something which would have looked like 29. We could have had a Great Depression because of the rapidity of the contagion, which I consider as one of the emerging properties of the new world in which we are, which is a world of marvels, but also a world of high risks. Now, let me concentrate on those particular risks that are more specific to Europe. And I mention that only because I am a European and I feel quite deeply this kind of difficulty. We have the geostrategic risks. Very unfortunately, Europe is at the border of Ukraine and Russia. The Baltics are also at the border of Russia, and there we have undoubtedly the perception of a new risks which did not exist a few years ago, but which now is perceived as a real risk by a number of European countries. Not all, not even all the Center and Eastern countries, but certainly perceived as a very big risk by Ukraine, of course, but also by Poland or by the 3 Baltic states. So I mentioned that en passant. We are close to the possible materialization of this geostrategic risk. Of course, we are very close to the Middle East. We are very close to North Africa. We are very close also to sub-Saharan Africa. And as you see, we have there a number of risks that are very, very important, obviously. It is the epicenter of the new, I would say, threats that are coming. And I mentioned that because, of course, this is a global risk. And this is a global risk in which the United States, for very good reasons, has been deeply involved before 9/11, after 9/11. But the fact that the Europeans are very close geographically to the epicenter of that risk, of course, creates a special, particular additional element of threat. And of course, associated with this geostrategic risk, we have the immigration, new, I would say, materialization of the risk, which I see is also an immense issue in the United States of America. I participated in the meditation on immigration here. But you are a land of immigration. You're coming from a fantastic success of immigration. It's not the case in Europe. Not in most countries, in most European countries, it's not the case. So the challenge for us is a gigantic challenge. The challenge is also gigantic because the culture are not the same. Culture and religion are not the same at all with this new wave of immigration. And that, of course, is an additional issue. As you can see, the Europeans have to cope with this environment with great difficulty, obviously, which does not surprise me. I would make the remark that this is a global issue. And we are on the front line because of geography. But we were not necessarily on the front line in the various interventions which took place earlier in Iraq or in the various countries in the Middle East. So I would call for the, I would say, international community as a whole to be fully aware that we have there a global issue and not only a European issue. But it is obviously a very, very big challenge for the Europeans. And then we have a last new challenge or risk, which is Brexit, and is something which is quite artificial, obviously, because it was really a risk which exists only because a decision has been taken to embark on a referendum. And I had some remarks made by Nick, if I remember, on France. I would say I was very surprised myself that the UK, the mother of democracy, of representative democracy, and we all owe a debt of gratitude, an immense debt of gratitude to the UK for that. I was very surprised that the UK would decide to embark on this Napoleonic Bonapartist concept, which is a referendum. and I really trust what I say. I mean, it's not probably not the best way to, even if my country has practiced referendum quite often, but I'm not sure that it is the best way for a representative democracy to have this particular way of deciding. But all that being said, as you see, we have a lot of challenges, a lot of difficulties that are at the global level very, very important, and particularly for Europe. Now, I reserve all possible questions on Europe for you, John, if you wish, because otherwise I would take too much time. And if you permit, I would conclude on this very short and brief remarks on what I have called conceptual convergence of monetary policy amongst the advanced economies, and as a consequence, as far as I see it, of the crisis itself. We have observed in at least I would say 4 dimensions, and I could find out more, but 4 major dimensions, a phenomenon of rapprochement between the conception of the central banks, the Fed, the ECB, Bank of Japan, Bank of England. As regards the monetary policy tools, there is an obvious consequence of the crisis, which is that we have all embarked on unconventional measures. We have all embarked on various unconventional measures with a great degree of imagination and creativity, credit easing, quantitative easing. In the case of the European, we also embarked very early on what I would call the off-balance sheet commitment. For instance, the full allotment at fixed rate was decided as soon as August 2007 by the European Central Bank. We have another off-balance sheet commitment in Europe, which is extremely important, which is the OMT, the promise to intervene and purchase treasuries of one particular country if that country has enormous problem. And in case, of course, there is a recovery program which is judged appropriate. OMT came after what was decided in my time, the SMP, which was at that time highly, I would say, critical, highly shocking way of purchasing some treasuries a few months after my speech here in the SIEPR in 2010, when you were kind enough to invite me. It was in March 2010, and as soon as May 2010, I had to purchase treasuries of Greece, Ireland, and Portugal. So I mentioned that en passant. We have all converged, even those who were the most, I would say, far away from the idea that unconventional monetary policy tools could be utilized. We have all embarked on this. We have also all embarked on forward guidance, even if the concept of forward guidance has moved quite a lot in the experience of the various central banks, but the convergence towards forward guidance, which was not obvious at the very beginning, has been observed in all central banks of the major advanced economy. A second dimension of convergence has been communication with the public. The ECB was used to have press conference immediately after the decision of the Council of Governors. That kind of concept, which was unusual in the eyes of other central banks, has been generalized, including in the United States of America. And I take it that it is something which corresponds to, the necessity to improve communication in a period of crisis, in a period where the request for understanding by markets and by the general public became very, very demanding and pressing. Also, I have to say the publication of the minutes, which was the privilege of the US and the UK, was also adopted by the Europeans. So the convergence has a lot of dimension, as you see, but we have now approximately the same concept for communicating with markets and with the public. A third dimension, which is also a very important one, of convergence of monetary policy, is that we were highly divided before the crisis as regards banking surveillance. You had two schools. One was saying the central bank should not be involved at all in banking surveillance. It was the case in London. The FSA was totally independent of the central bank, totally out of the central bank. It was, and it still is, by the way, the case in Japan. And in Europe, in continental Europe, in the euro area, we were profoundly divided between the two schools. Of course, the ECB had no involvement at all, but some nations adopted the proximity of banking surveillance vis-à-vis the central bank, and others considered that the separation should be strict, as was the case in the UK. And then the US was more or less in between. But at the moment I'm speaking now, we all consider, I put Japan aside, but on both sides of the channel and both sides of the Atlantic, we consider that a high level of proximity between banking surveillance and the central banking institution is something which is probably appropriate in the light of the crisis. And that is an element of convergence which I have to mention as a very important one too. Now, the last one, and I discussed that with John, is absolutely striking. It is the heart of the mission of the central bank, delivering price stability. In the vision of the European and of the inflation targeters, the idea is if you deliver price stability, you are paving the way for sustainable growth and job creation in the medium run. So there is a complementarity between the various goals that you can ask the central bank to deliver. And in the United States of America, as you know, the law says price stability, low level of long-term rates, and jobs. But the idea that there is a link between sustainable jobs and sustainable growth and appropriate price stability in the medium run is also something which I think is considered important by many economists in the United States. But we didn't have the same definition of price stability. So we were all in favor, or asked to deliver price stability, but we had not the same definition. And the definition counts. So two big central banks had no definition of price stability, the US and Japan. The two others, amongst the four big central banks of the advanced economy, had a definition, which was 2% in London and less than 2, but close to 2 in continental Europe in the ECB. At the moment I'm speaking, and since 2013, so in the experience of the crisis, we have now the same definition of price stability. It was in 2012 that the Federal Reserve said, what we understand as price stability is 2%. And in Japan, it was, if I'm not misled, in January 2013 that the Bank of Japan said, our goal is 2%, and it is our definition of price stability. So I draw your attention to the fact that this is an element of convergence, which is very, very important. All central banks issuing the currencies that are in the basket of the special drawing rights, but China being the last to come, but the four previous currencies that were in the basket have the same definition of price stability, which in my opinion might have important consequences in terms of international monetary system handling and functioning. It is, again, since ever, we have an SDR which is in principle anchored nominally by this 2% medium-term price stability of all currencies that are at stake. Now, let me, and as I said, I could elaborate more on these conversions. I stop there, and I promise to have a last message at the end of my introductory exposition. So as a conclusion, I didn't speak too much of Europe, but I will do that now. But I would only draw your attention to the following. Europe has all the problems of the United States of America, because we are a big continental, very large, continental, I mean, in the sense of Ireland is also, of course, part, and I hope perhaps one day the UK could join, but we are a very big single market with a single currency. So we have all the problems associated with the US, which is an immense single market with a single currency. We have approximately the same size. On top of that, we are constructing historically something when the US has terminated its own construction. A lot of problems, a lot of, I would say, updating of everything in the US, a lot of imagination and creativity, but not a dramatic change of the very construction. In our case, we are still history in the making. And that is, of course, something which is extremely demanding on us. But not demanding to the extent that our own existence could be put in question. And that's my main message. Because when we had to cope with this dramatic crisis, which has been the worst since World War II, and perhaps could have been the worst since World War I, in the US as well as in Europe, a lot of observers, particularly I have to say in Asia and perhaps in the new hemisphere, were considering the euro will evaporate and disappear because it's too bold, too new, start from scratch, cannot hold in this dramatic crisis. And the euro area will evaporate because, again, it was such a bold construction, such an incredible experience starting from scratch, never tried in the history of humankind, and so forth and so forth. So we went through that experience. As a matter of fact, we are 6 years after my speech, and at that time, the worst episode of the sovereign risk crisis had not started yet, and it was 2 months before the start of the worst episode of our own financial crisis, which was the sovereign risk crisis. Now we are 6 years afterwards. The euro, during all the crisis, hold remarkably well, contrary to a lot of imagination or projections or anticipation, to the extent that the main criticism on the central bank was, for a very long period of time, the euro is too strong, which is perhaps bizarre when you're supposed to speak of a currency about to collapse, about to disappear, but everybody can check. The main criticism was, why is it that the euro is too strong? The central bank could take care of that. And a second remark was that the euro area, which was supposed to evaporate or being dissolved or disappear, not only did not, but, and this is something which I very rarely see in articles and comments, we were 15 countries at the moment I came here 6 years ago. The 15 countries are still there in the euro area, including Greece. And in the case of Greece, because 70% of the Greek people wanted to stay in the euro area. So it's something which is quite strong. I would say the underlying glue that makes the euro area hold is really much more solid than one could imagine. So the 15 are still there. But on top of that, 4 new sovereign countries entered in the euro area since the collapse, the bankruptcy of Lehman Brothers. The 3 Baltic states and Slovakia. So at the moment of speaking, we are 19. We were 15 at the moment of the bankruptcy of Lehman Brothers, and we are 19 today. And I say that only to tell you that there are real issues for Europe and there are false issues for Europe, as far as I see it. The real one is we will consider that it is a full success when we will deliver growth, and I would say the same growth per capita as the other advanced economy, US in particular, and we will deliver full employment. When we have growth per capita and full employment at the appropriate good level, then we will consider that the euro area and the euro was not only a fantastic, bold historical endeavor, but a very successful, bold historical endeavor. So that's for real. This is the right question. This is the right challenge for us. A false question, a false challenge is to say this is very, very fragile. The euro is very fragile and will disappear. The euro area is very fragile. And I think that this is wrong. And I can prove it because, again, we went through the worst crisis, financial crisis, since World War II. Don't forget, a crisis that, in its last episode was a terrible challenge for Europe, but the first episode was the threat, the immediate and grave threat of collapse of a lot of institutions in Wall Street. So it was really something which was very big, and we can prove it because we could see that had, again, the Federal Reserve not reacted immediately, we would have had a sequence of bankruptcies that would have been as dramatic as in 2930. So that's my last message in the introductory remark. And I thank you very much for your attention.
Thank you very much, Jean-Claude. It's great to be here with you, and thanks for remembering the many years we were together. I just want to sort of echo something Dana said at the beginning about Jean-Claude being a real friend of the United States. Back in the days after 9/11, when especially when we began this war on terror. There's lots of disputes and discussions and disagreements. And at the American Embassy in Paris, Ambassador Howard Leach decided, well, we should have a discussion of this, and he invited Jean-Claude and myself to have a discussion. And these were the days where, believe it or not, people wanted to change French fries to freedom fries, things like that. But you gave a sense of importance to this relationship between our countries, and it made a lot. In fact, you were sort of mystical. It was so important. In fact, when I wrote about this in my memoir, I called him Jean-Paul, thinking it was the Pope, I guess, or something like that. But no, thank you for that. I want to just ask two questions. I know many people have questions, but maybe one from before the crisis and one after, based a little bit on things we did together. Back in 2014, there was a period where we were trying to get the Chinese to move their currency. There was a peg to the dollar. It was quite a difficult time. And the idea was to encourage China to have a flexible exchange rate. And we didn't want it to just be the United States. We thought it should be important to have France and Germany and the rest of the G7. So we had a meeting. It was in Florida, the G7. And 4 people went into a room, Alan Greenspan, Jean-Claude Trichet, Mervyn King, and myself, to kind of iron out how we're going to describe flexible exchange rates as a goal for China, meaning appreciating the currency, in a way that we could all agree. And it was very hard because, and this is more of a question, as you'll see in a minute, it was very hard because at that time, the US had a 1% interest rate, February 2014. It wasn't like inflation was low, it was above 3%. And so there was a sense in which maybe this was too low, and my sense that, and this is specific from the conversations, you thought that if we said flexible exchange rates, everybody said, oh, that must mean the euro is going to go up. That's going to let the pressure off the euro and go up, and that's just not what you want, especially with the 1% interest rate in the US and higher in the Eurozone. So you're the president at the time. So the question is, how much, going a little bit to your question about central banks converging, was there some sense of that low interest rate in the US motivated you with exchange rate concerns to have a somewhat lower interest rate in the ECB? This is many years after the fact, but I thought it would be something to raise with you now.
Yeah, first of all, I have a very vivid memory, of course, of this episode. It is true that I have permanently had the sentiment that we had a threat of, I would say, possible instability or the re-emergence of instability in the exchange rates between the major currencies, independently of the problem of the yuan, which was a special problem. But it's true that since the explosion of the Bretton Woods system, we could see episodes of volatility that have been really gigantic. The Carter dollar and the Reagan dollar, vis-à-vis the European currencies, moved in the proportion of 1 to 3 between, before the accord that we had in the Plaza and perhaps also in the Louvre. Since the setting up of the euro, we have had episodes where the euro was as low as 0.83 dollar and as high as 1.59. So I think we have a potential for immense volatility, which might have been acceptable immediately after the Bretton Woods explosion, at a time where the interconnection between the real economy, even inside the transatlantic link, and of course, at the same time, the interconnection between the financial institutions was much less intense. So I feel at that time that there was a risk and we had to be very cautious and prudent. By the way, we went through the crisis, this dramatic crisis that we all know, without too much drama in the exchange rate
Yes.
positioning of the various major currencies of the world. It would have been a total catastrophe had we had to cope with, on top of all our problems, a destabilization of the IMS in the core of the currencies of the international monetary system. It seems to me that it is still a major problem today, and I am very uneasy with what I observe in practically all advanced economy, namely the mainstream of, I'm not saying you, John, but a lot of economists analyzing the sterling, the yen, the euro, and the dollar on the basis of the positioning of the currency vis-à-vis the other major currencies. So this is obviously a zero-sum game, and it would be extraordinarily dangerous that we would concentrate really on that. We have to get an appropriate accord on the concept, respect this accord, and do not let our own public opinion calling permanently when we are fighting against deflation for the lowest possible currency. But tomorrow we could fight against inflation, and then the very same trap could function upwards. So we would all call for the highest possible currency vis-à-vis the other. In both cases, it is a zero-sum game and a recipe for abnormal behavior, if I may.
Yeah, you call it a trap. Some people call it a currency war, and you have to be careful of it.
No, we are not there. We are not there.
Not there yet. I want to use Hal's free good thing here for a minute. This is the speech that Jean-Claude gave here in March 12, 2010. It's right on the internet. Put it up on my iPhone. I don't know if it's part of GDP. If I paid $500 for it, it's worth at least that. But there's a phrase in this speech which I think is important in light of your commenting on central banks converging. And this is a statement that you, as president of the ECB at the time, was talking about the ECB. This is written down at the time. It's very important to get the records. But let me read from it and ask if you could comment. We are convinced that a delayed exit from extraordinary liquidity support would distort market behavior and misallocate credit. That is 6 years ago. And you were talking about phasing it out. And yes, there was Greece, but America didn't have a Greece, Japan didn't have a Greece, but we're still doing this 6 years later. And so the question is about distorting market behavior and misallocating credit. Is a concern, and do we need to get off of this sooner than later?
First of all, I would not change a word of what I said, because I think that it should be a permanent observation, and we should have permanently in our mind that we have unintended consequences associated with the extraordinary measures that we are taking. Of course, the paradox is that I was mentioning the full allotment at fixed rate, that we were practicing massively, which was an off-balance sheet commitment, but able to I would say, be sure that there was a saturation of liquidity in all the euro area economy. I was not yet mentioning the S&P, namely the purchase of Greek treasuries, of Irish treasuries, of Portuguese treasury, or S&P2, which was the purchase of Spanish treasuries and Italian treasuries. So we went much further, of course, and also much further with QE, US-like in Europe. I would say that this consideration, which drove the US Fed to taper and to start, I would say, the reversal that I considered appropriate, is not yet practiced in my own continent, if I may, or in Japan. In the case of Europe, it's absolutely clear that because of the sovereign risk crisis, we are late in the cycle vis-à-vis the United States of America, perhaps 2.5 or 3 years. But this episode of sovereign risk has been very, very dramatic, obviously, to the extent that it was considered an existential issue for Europe. Wrongly so, but it was the sentiment of the observers, or many observers. And I would say that, so it's not very surprising that it's not yet for us the moment where we start the tapering, quote unquote, and the elimination of the unintended consequences of what we are doing. But my main observation today would be, I already said that, what is functioning so poorly in the US, in Japan, in Europe, in the UK, which deserves this special treatment by the central bank. Now, even in the United States of America, we had the tapering, we had the first increase of interest rate, but nobody is speaking of selling the $4 trillion that are in the balance sheet of the central bank. So we see, and I mentioned the thought experiment. We perceive that the spontaneous functioning of our economy is not yet at all at an appropriate level, and that the central bank are doing all what they can to offset what would be probably a spontaneous functioning that would be very disappointing, to reutilize the word.
Thank you. So we have some time for some questions. I know some people were anxious to. I see one way in the back. I think I can't see, is that Mike? Yeah. Mike gets the mic.
Yeah, thank you. Yesterday there was a peculiar reaction to the ECB meeting conclusion, where when the press release came out, the market moved significantly one direction, and then when the press conference began, a statement regarding forward guidance was made, and the market moved back the other way quite significantly. And to me, this is the last, most recent example of forward guidance adding volatility, a source of volatility, rather than a source of stability. And I remember when you were president, you often would say, "We never pre-commit." And that was, I thought, quite appropriate. And to me, time and consistent forward guidance has again and again been an unnecessary source of volatility. And I would love to hear your views on how successful you think the forward guidance has been practiced by the major central banks that, as you described in your talk. Thank you.
It's a very important question. I don't think that what happened on Thursday has anything to do with forward guidance. I think that the very short-term reaction of the market has been now more or less eliminated, at least when I look at the 2 days market, both the stock markets in Europe and also the fixed interest rate market. The full impact of what has been decided on Thursday seems to be captured by the market. I think there was an overreaction, which is difficult to analyze because the sentence which was at stake was, at the present moment, after the decision we just took, I don't see in the cards a further decrease of interest rates, but things and data can change. So it was totally open, and it was coming after a sentence which was saying we will maintain for a very long period of time, even after the end of our QE, the very low rates or even lower rates. So when you read what was said. So I think, from time to time, you have artifacts in the markets that, should not necessarily be considered highly significant, frankly speaking. That's my understanding. On forward guidance, it's true that in my time, the sentiment we had, and I had, was that it was much better that the market would know that we could react anytime, up or down. I call that credible alertness in order to take care of possible changes. And I trust that this idea that we are living now in a highly unpredictable universe, and we could have changes that were not predicted at all, that we are not in the regular cycle. Look, in the US, it's clear that we are uncertain of the cycle, which explains the prudence and the caution of the Federal Reserve Open Market Committee. So it seems to me that we are in a universe which is highly unpredictable. When you are in a situation where the threat of materialization of deflation looks very high, which was not at all the case in my time. In my time, I had absolutely no problem with the solid anchoring of inflation expectations at the level, medium term, at the level of 1.9%. From that standpoint, I had to cope with the dramatic start of the sovereign risk crisis, but not with the unanchoring of inflation expectations. And so I can accept that when you are, and it was the case in the UK at the time, it's been the case in the US, been the case in Europe, certainly the case in Japan, the idea to tell the market you can count on the fact that our interest rates will remain at a very low level for a long period of time is something that, I can understand, even if living in a different universe, I myself did not practice at all forward guidance in that sense. My forward guidance was we can react anytime. We are not pre-committed.
I think question from Randy Quarles right here in the first row. Oh.
No,
Nope.
that's
Okay.
not my name, but if you called on me, then I'd like to ask the question.
No, you can absolutely ask the question. I know it's your name, but Randy was here. And
Oh, I'm sorry, I didn't
It's
see it.
okay. Go ahead.
Okay, the question, hopefully this will be a
It's an
fairly brief question.
Open mic.
Yes, and that is that in the early days of the crisis, the low interest rates and QE1, QE2, the comments were made that all of the pressure was being put on the central banks because of the lack of stimulative fiscal policy. When our stimulus ran out, so to speak, we didn't do it again. In fact, we contracted. And I'm just wondering if you would comment on that factor today and whether that's true in Europe, it seems to be true in the United States, and what role stimulative fiscal policy could play in reducing the pressure on the central banks to keep us afloat.
Comments. First comment, 40% approximately of the euro area balance sheet has been threatened by sudden stop of financing. So this is an experience that we had in Europe, which has been totally dramatic. We eliminated the sudden stop materialization with SMP 1, SMP 2, and OMT. And of course, it went without saying that at that time, if we wanted to succeed, and we succeeded, we needed not only the formidable help of the central bank, but also the appropriate adjustment by the countries concerned. So 40% of the euro area was threatened by sudden stop of financing. And of course, this was the immediate threat that you could see when you were looking at the market literature coming from all major marketplaces, including, of course, New York and London and the European marketplaces. So it was a very grave situation. There, of course, what one called austerity was absolutely compulsory. It was not austerity. It was going progressively back to more balanced economy, both domestic economy and external side of the coin, more balanced current account, in order to convince the investors and savers of the entire world that they would count not only of the central bank for the country in question not to collapse, but also for the effort of the country. So I put aside the 40%. Now, the 60% remaining were made of two categories. Those who were not in a good situation, but were not under the immediate heat of the sovereign risk crisis, and you had several countries in that situation, and countries that had room for maneuvering, important room for maneuvering. And of course, everybody thinks of Germany, the Netherlands, and perhaps one or two other countries. For those countries, you could argue you have room for maneuvering on the fiscal side, and why don't you utilize your room for maneuvering? But I have to say that it's highly theoretical, because when you look at the overall, I would say, functioning of the society is concerned, say Germany to oversimplify, the simple idea that in such a dramatic crisis, it would be appropriate to have a higher level of deficit would have been considered by the people of this country as totally dramatic, because they would have said, it's contrary to common sense. We are losing confidence. If not only we see our own central bank doing things that are totally extraordinary and totally unpredicted and highly dangerous potentially, but on top of that, our own government is embarking on deficits voluntarily, it would have been, it would have backfired, in my opinion. So what I would have hoped from this country would have been another way of activating their domestic economy. And what I say is still true today. I expect wages and salaries to be more dynamic. I expect the unions to be more demanding. I expect the unit labor cost to go upward, which would be good, of course, for the activation of the domestic economy. I would expect investment, private investment, to be much more dynamic. And then we would have domestic demand going up, of course, a booster for the overall real economy of that particular country, which has an immense current account surplus of something like 8.5% of the GDP. Our friends in the Netherlands might have something like 9.5% of the GDP of current account surplus. So you have room for maneuvering for activating your domestic demand. And of course, on top of that, it would have, and it would permit the other countries to adjust their relative competitiveness vis-à-vis these countries that have augmented formidably their relative competitiveness in the euro area, have a big current account surplus, and must let now some kind of rebalancing of the relative competitiveness. But if the unit labor cost remain flat in the most competitive countries, then national inflation would remain at a zero level, or has a good chance to remain at a very low level. And there, all the others have the choice either to lose again competitiveness vis-à-vis the best, I would say, and most competitive countries, or to be even more negative, to catch up with their lost competitiveness. But then they desperate the ECB, which has an average inflation which would remain desperately low or even negative. So you see, we have an absolute need, in my own understanding, for those particular countries to have what I would call a normal functioning of a market economy. Our enterprises are very profitable. We have a very high level of current account surplus. It's normal that the unions are more demanding, that the labor is more demanding, and that we have this activation of the economy, which is overdue, obviously. But I hesitate to say that. But even now, knowing Germany and the German public opinion very well, I would say if you have a very good reason to embark on public spendings, for instance, immigration, that's a good reason. Everybody can understand that there is a case there for public spending and to be up to the challenges that exist today. And there, I would say the public opinion would accept that. But if you say only abstractly, we have a need to spend more because to activate the economy and so forth, I mean, the men and women in the underground
in Berlin or Frankfurt would say, well, they are playing wrong. Where are we going? And then they are losing their own confidence, and it backfired, as I said. It would have backfired in the past. It would still backfire in the present situation. And I think that the German government is pretty aware of that, and the German Bundesbank pretty aware of that, because both have a rhetoric which is very unusual and says unions should be more demanding. As you could see, the minimum wages and salaries were introduced in Germany. I mean, there are signals that are given and that are going in what I would call would be probably the best move in the circumstances.
Thank you, Jean-Claude.